What are the hidden truths within housing market reports? Imagine looking at a house price chart and thinking you understand the entire market. But beneath those numbers are details that can change everything you believe about the data. Housing market reports are packed with useful information, but they can also hide some important truths. First, these reports often show aggregated data that can hide local differences. For example, a city might have rising prices overall, but some neighborhoods could be declining. If you only look at the citywide numbers, you might miss opportunities or risks in specific areas. To get a clear picture, you need to analyze micro markets and understand how different neighborhoods behave. Second, market reports usually relying on data from closed sales. That means they reflected transactions that happened weeks or even months ago. If interest rates or local policies change quickly, the report might not show those shifts. So, the data can be outdated by the time you see it. Always consider current economic conditions alongside the report. Third, the data can be influenced by off-market deals or large investors buying properties outside normal channels. These transactions can make supply seem tighter or prices higher than they actually are for typical buyers. This can distort the real market situation, especially for smaller investors trying to find affordable properties. Fourth, many reports include comparative market analyses or CMAs. These relying on selecting similar properties called comps. But small differences in location, condition, or features can make a big difference in value. Automated tools might not catch all these nuances, so it's smart to interpret CMAs carefully and consider confidence levels or volatility indicators. Fifth, reports often focus on past data, but they don't always account for future trends. Economic factors like rising interest rates, demographic shifts, or new policies can change the market quickly. Savvy investors use predictive tools and economic indicators to anticipate where prices are headed, not just where they have been. Sixth, breaking down data by buyer type, property style, or price range is essential but often overlooked. For example, luxury homes might follow different trends than entry-level properties. If you focus only on broad numbers, you could miss important patterns relevant to your investment goals. Finally, market reports don't always reveal underlying risks or signs of bubbles. Rapid price increases combined with declining inventory and more investor activity could signal overheating. Without careful analysis, you might think a market is sustainable when it's actually at risk of a correction. Using market reports wisely means starting with the data but also adding local knowledge and current economic insights. Look beyond the headline figures and consider how off-market deals and investor activity influence the market. Segment the data to focus on the property types and buyer profiles that matter most to you. This way, you can spot genuine opportunities and avoid potential pitfalls hidden within the numbers.